How banks deceive you: high inflation vs low interest rate. Inflation is the rate at which the general price level of goods and services is rising, and subsequently, purchasing power is falling. Central banks attempt to limit inflation and avoid deflation in order to keep the economy running smoothly. One way central banks can influence inflation is by setting interest rates. Interest rates are the cost of borrowing money, and they can affect both consumer and business borrowing and spending. When central banks raise interest rates, it becomes more expensive for consumers and businesses to borrow money, which can lead to a decrease in spending and demand for goods and services. This can help to reduce inflation. On the other hand, when central banks lower interest rates, it becomes cheaper for consumers and businesses to borrow money, which can lead to an increase in spending and demand for goods and services. This can potentially lead to higher inflation. It's worth noting that there are many factors that can influence inflation, including economic growth, unemployment, and supply and demand for goods and services. Central banks must carefully balance the need to maintain low inflation with the need to support economic growth and employment. It's important for individuals to be aware of the relationship between interest rates and inflation and to consider the potential impact on their financial plans. For example, if you have savings in a low-interest savings account, and inflation is high, the purchasing power of your savings may decrease over time. In this case, it might be wise to consider other options for saving and investing your money.